Hello everybody, this is Markus Rudolf from WHU Otto Beisheim School of Management, and I'd like to present you today with a little primer on the derivation of the capital asset pricing model. I'm a professor of finance here at the school, WHU Otto Beisheim School of Management, and the derivation of the capital asset pricing model belongs to the most basic and most fundamental issues that finance students need to learn. What you see here behind me is basically a couple of posters which allow us to do a complete derivation of the CAPM out of Harry Markowitz's portfolio theory, which has been invented in the year 1952. What you see here on the left-hand side is basically a simulation of a three-asset portfolio. We have three assets here. One is called the low-risk asset, the other one is called the international stock portfolio, and the third one is a private equity portfolio. And what you see here is a couple of different dots, blue dots. Those blue dots, those are 150 of those blue dots, have simply been generated by a simulation strategy where we simply randomly selected the portfolio proportions of the implied portfolio assets and combined them with a random variable generator, with a random number generator. And the result is here, we have 150 different volatility and expected return combinations. And as you can see, the outer boundary of that cloud of points is the very well-known efficient frontier as it has been developed by Harry Markowitz in his seminal paper in the year 1952. So we all know that basically this line here, which I have added to that chart, delineates the set of efficient portfolios in the sense that any of those points has the lowest volatility given a certain amount of expected return compared to all of the other points which are on the same expected return level. So therefore, all of the assets which are here along that line are the most efficient portfolios that you could invest in because they reveal the lowest volatility given an expected return level. So that's basically the first chart that you have here. If you go over to this chart here, then you see not only a blue cloud of points, but also a green cloud of points. And the green cloud of points is a very similar way of simulation as the one that I have explained before. The only difference is that the green cloud of point assumes that there exists a riskless asset. In our case here, the riskless asset has an expected return of exactly 1%, and as the term says, riskless, it doesn't have any volatility. So the riskless asset doesn't reveal any volatility, nor does it reveal any correlation to the remaining assets. Now, if you look at the green cloud of points, the cloud consisting of the green points, then you can see that there is still a way to delineate the boundary of that cloud of points. But in contrast to the efficient frontier which has been developed by Harry Markowitz in 1952, the green cloud of points does not have a concave frontier, it does simply have a linear frontier. So again, if you go to one of those points, this point here for instance, has exactly the same expected return like the other point. So point A has the same expected return like point B, and both have the same expected return, namely 17%, but point A obviously reveals a lower amount of risk than point B. So therefore point A dominates point B because it has the same return but a lower risk in terms of volatility. So therefore anyone who is a rational investor would always go for portfolio A instead of for portfolio B, and all of those portfolios which are efficient in that sense can be delineated by that green line here. So the green line is simply the boundary line of the green cloud of points. The gray line here is the boundary line of the blue cloud of points. Now, the gray line here, as you know, again, is the efficient frontier as it has been developed by Harry Markowitz. The green line is also a kind of efficient frontier, but we don't call it an efficient frontier. We call it the capital market line. The capital market line is a concept which has been developed by James Tobin in his 1958 seminal paper. And what we also see is that the capital market line dominates the efficient frontier in all points. There's just one exception, namely the only exception here is the tendency point. That is the point where the efficient frontier and the capital market line are tangents to each other. So basically, the capital market line is the ingredient that you need in order to derive the capital asset pricing model. But unlike in the capital asset pricing model, the capital market line does not characterize an equilibrium. The capital asset pricing model is a capital market model. In other words, it characterizes the financial markets in total. In other words, the entire demand side and the entire supply side of and for financial assets is captured by the capital asset pricing model. Here on that chart, we have only the decision situation of one singular investor, namely an investor which either takes the riskless portfolio into consideration, or if we look at the classical efficient frontier, which does not take the riskless asset into consideration. So to say, the capital market line is the best efficient frontier that you could invest in if there is a riskless investment opportunity. So the question that I'd like to address next is, how could we and how would we be able to analytically access and describe that capital market line? In order to do that, I would like to draw your attention to the chart here on the left-hand side. Namely, we start with equation number 1. The idea is basically that any portfolio which is along the capital market line is a combination of the riskless portfolio, which I call R, and the portfolio which is on the tangency between the efficient frontier and the capital market line, which I call M. So any portfolio along the capital market line can be obtained by a combination of R and M. R is the riskless portfolio, M is the tangency portfolio. The fraction by which I'm investing in R is 1 minus Wm. The fraction by which I am investing in M is Wm. So therefore, I can reach any point by simply reallocating Wm and 1 minus Wm. So for instance, if Wm equals 1, I would exactly reach that point. If Wm equals 0, I would exactly reach this point. If Wm is 50%, for instance, then I would reach this point, a point which is right in the middle between M and R. So therefore, if you look at the expected return on any asset along the capital market line, and assume we call that expected return mu, then we know that this mu, namely the expected return on the capital market line, is simply a linear combination of mu m, which is the expected return on portfolio M, and R, which is, so to say, the expected return of the riskless asset. Of course, in the case of a riskless asset, expected returns and realized returns are exactly the same because there is no uncertainty involved. So mu is the expected return on a capital market line asset, and it is obtained by simply multiplying the weight of M times the expected return on M plus the weight on R times the return on R. Wm times mu m plus 1 minus Wm times R. That is the expected return on any asset which lies on the capital market line. If I'm now rearranging terms a little bit and put the Wm out of the brackets, then I obtain this expression, namely mu equals R plus mu m minus R times Wm. So that is the expected return u on an asset which lies on the capital market line. Now we have the standard deviation u, or the volatility u, on an asset which lies on the capital market line. The volatility on any asset on the capital market line, according to the classical variance formula of a portfolio consisting of two assets, is the variance on portfolio M, sigma m squared, times the weight of portfolio M, Wm squared, plus the variance of portfolio R, sigma r squared, times the weight of R, which is 1 minus Wm squared, plus 2 times the weights and the covariance. What we have here, this is the covariance between M and R. So that is the covariance between M and R, and as you might know, the covariance is exactly the same like the product of the two volatilities times the correlation coefficient. So here we have the volatility of portfolio M, here we have the volatility of the riskless asset, here we have the correlation coefficient between the riskless asset and portfolio M. Now, if you look at that formula here, and if you look at the riskless asset, then it is quite obvious that the risk of the riskless asset is 0. In other words, this is 0, right? Secondly, the risk of the riskless asset is 0 also here. By the way, also the correlation coefficient between a riskless asset and a risky asset is 0 as well. So in other words, we have a 0 here, we have a 0 here, so therefore this can be eliminated and this part can be eliminated. Both of those parts can be eliminated. Everything which remains is sigma squared equals Wm squared plus times sigma m squared. And if I basically square root both sides of the equation, then I obtain that the volatility on any asset which lies on the capital market line is equal to Wm times sigma m. So quite easy. What I now can do, of course, is I can solve the whole thing for Wm so that I obtain that the weight on m is simply equal to sigma divided by sigma m. And now I can substitute that Wm into here. So that I then obtain that mu equals r plus, and now I'm substituting the Wm by sigma divided by sigma m times mu m minus r. And what I have here, this is the equation of the capital market line. This expression in the red box is called the market price of risk. Because firstly, it expresses how steep the capital market line is. That is the steepness parameter of the capital market line. And secondly, and that's the reason why it's called market price of risk, it is the expected excess return on the portfolio M divided by sigma M. So to say, this is the return, extra return on portfolio M for each unit of risk that portfolio M reveals. So the market price of risk is the extra return that you can expect when you buy a risky asset instead of buying a riskless asset for each unit of risk. So in other words, assume that the market price of risk is 0.5, then for any extra unit of risk you get 0.5% more return expectedly, which implies for 10% more risk you get expectedly 5% more return. Then that is called the market price of risk. This is the equation of the capital market line. And now, if your attention is put on that slide here on the right-hand side, we are trying to derive the capital asset pricing model out of the capital market line. Now, before we start here with equation number 5, there are a couple of things which have to be regarded. Because the step and the transition from the capital market line to the capital asset pricing model is analytically not extremely complicated. But economically, there is really something which is inside there. Namely, the capital market line expresses which risk-return combination one single investor in the most efficient case would be able to obtain. The capital asset pricing model, however, would like to express what the expected return on an asset is at the capital market if everybody buys and sells his or her assets according to the capital market line. In other words, we need to do an equilibrium consideration, and an equilibrium consideration typically implies that the demand side and the supply side is put in a balance to each other. So therefore we have to look at the supply and the demand side. Now, in order to do that, let us look at the variance on any asset I which is on the capital market line. So any asset I has a variance of sigma I squared. What we can do is we can rephrase sigma I squared by simply subdividing the sigma I squared into two components. One component is the rho Im squared component. Rho Im is the correlation coefficient between the returns on that particular asset I and the portfolio M. And sigma Im squared is this expression squared. 1 minus rho Im squared is 1 minus that squared correlation coefficient. So basically, if I put those two together, the sum is 1. The sum is equal to 1. Sum here is equal to 1. So now, in other words, I'm simply subdividing the sigma I squared in a component rho squared times sigma I squared, and in another component 1 minus rho squared times sigma I squared. Now, what is important is the interpretation of the rho squared. The rho squared is the correlation coefficient between asset I and the portfolio M squared. Now, if you are a little bit familiar with regression analysis, then you know that within the concept of regression analysis, we have a quality measure which we are typically calculating called R square. Now, the R square is exactly the same thing like the rho squared, namely it is a squared correlation coefficient. In the context of a regression analysis, the R squared is the correlation coefficient between X and Y, if Y is the dependent variable and X is the independent variable. Here we have rho squared, and that is the correlation coefficient. That is basically the measure of determination, or that's the R squared of a regression analysis where I is the dependent variable and M is the independent variable. So basically we can say that rho squared IM expresses how much I is determined by M, or which percentage of I returns are explained by M returns, because I is the dependent variable and M is the independent variable. So basically we can say that M explains I and rho IM squared expresses by how much this is the case. Now, we need now a consideration of the portfolio M. What you know is that M is the only portfolio along the capital market line which people are willing to buy. M is the only risky portfolio that people are willing to buy. All of the other risky portfolios along the efficient frontier are not attractive. So nobody would ever buy any other portfolio but M. And any portfolio consists of a combination of R and M. M is the only risky portfolio that people are willing to buy. What we now need to do, and that is the economical part that we need to take care of now, is we need to characterize what M might be. What kind of portfolio might M be? Now basically M is the only portfolio that people are willing to buy. Anything which is not part of the portfolio M is an asset that people are not willing to buy. People are exclusively purchasing assets which are part of M, and they are not purchasing assets which are not part of M. So basically we can say M summarizes all assets which exist at the capital market, because obviously those assets which are existing are assets that people are buying. Right? An asset that nobody wants to buy is not an existing asset, is not an asset. Assets are only stocks or shares or companies that people are willing to buy since they make a difference, since they have a value. Now, the portfolio M is the only risky portfolio that people are willing to buy, and obviously this comprises and summarizes all of the risky assets that people are holding at the capital market. So therefore, in the literature regarding the capital asset pricing model, the portfolio M is called to be the market portfolio. And the market portfolio is a combination of all assets which exist, capitalization weighted, put together. That's a very theoretical construct, because if you're really talking about all assets which exist, that implies stocks, it implies bonds, it implies domestic stocks, foreign stocks, it implies also foreign exchange, commodities. It might also imply assets which are not traded, like human capital, for instance. So basically the construction of the market portfolio in the capital asset pricing model literature is comparatively theoretical. What you can do is you can try to approximate this portfolio M by a market index, like for instance by the S&P 500 index or by the MSCI World Stock Market Index. But we need to be aware of the fact that this is always only an approximation. A capital market index is an approximation of that portfolio M, as those who have developed the capital asset pricing model understand a market portfolio. A market portfolio is the capitalization weighted index consisting of all assets which exist. So basically the portfolio M is the market portfolio. That's the reason why we call it M. And rho IM squared is the extension by how much the asset I is explained by the market portfolio. In other words, rho IM squared tells us how much the asset I is explained by the market portfolio and how much the fluctuation of a single stock I are influenced by the market portfolio. So we call that part of the risk of the volatility sigma I squared, of the variance sigma I squared, we call that part of the risk which is influenced by rho IM squared systematic, because it fluctuates systematically with the entire market. Anything which is defined by the entire market is a systematic risk. Anything which is not driven by the entire market is unsystematic. So any company, be it a huge blue chip company like in Germany, Henkel for instance, has components of its variance which are driven by personal decisions and individual decisions which are taken in the company, but they are also driven by the market as a whole. Any German blue chip company is driven by the DAX, which is the German market index. But it's also driven by individual aspects and individual factors which are company specific. Those company specific factors are called unsystematic risks, and the market specific factors are called systematic risks. Now, what we also know from Harry Markowitz's portfolio theory is that we can diversify risks away until we reach a level of risk which is equivalent to the market level of risk. So what we know is that when we add assets into an asset portfolio, so if n is 1, 2, 3, and so on, then the volatility of the portfolio consisting of the assets goes consistently down the more assets are in the portfolio. So the more assets we have, the lower is the risk. But that does not mean that you can diversify all of the risk away by simply adding sufficiently many assets to the portfolio. There is a level of risk when you have 10 or 20 or 30 assets included in your portfolio, below which you do not get anymore. And this is called the market risk. So that's basically here, the market risk, the sigma m. Sigma m is the market risk, sigma m is the undiversifiable risk. So if we go back to our equation 5, the undiversifiable risk is the risk which is driven by the market, and the extent by which the risk is undiversifiable is given by the rho IM squared. The diversifiable risk, which is called the unsystematic risk, this can be diversified away. In other words, if you buy a portfolio of assets, you don't have to hold unsystematic risks, because diversification, which is costless, allows you to get rid of that unsystematic part of the entire risk. It's a personal decision of you, whether you would like to hold unsystematic risks or not. You can do that, but nobody is going to pay you for that. In an equilibrium situation, nobody is paying you a risk premium for a risk that you don't need to hold. So therefore, the diversifiable risk or the unsystematic risk is not relevant in an equilibrium situation when it comes to the evaluation of assets. So therefore, the only risk which is relevant in the end is the systematic risk component. And the systematic risk component is rho IM times sigma I. If we have an asset which has a volatility of 30%, let's assume we have a 30% volatility of the asset. And let's assume that this asset is correlated by 0.8 with the market portfolio. So in other words, 0.8 is the correlation coefficient. Then we find that the systematic volatility of that asset is 24%. So we have a 24% systematic volatility component. We have a 30% volatility component in total, but the systematic risk component is only 24%. The remaining 6% are unsystematic risk ingredients, and those can be diversified away free of any costs. So the logic of the capital asset pricing model is that we have an equilibrium situation in which nobody would like to bear risks which don't have to be beared. In other words, unsystematic risks don't have to be beared, and therefore nobody pays you for those unsystematic risks, simply because you can diversify them away free of any costs. So the only risk which really matters in the end is the rho times sigma I That is the systematic risk. And what I'm now doing is I'm simply rearranging the expressions a little bit. So for instance, what I'm doing here is I'm re-expressing the correlation coefficient in terms of the covariance. Sigma IM is the covariance between the asset I, which we are looking at, and the market portfolio, divided by the product of the two volatilities. That is exactly the same like the correlation coefficient. The correlation coefficient is defined by covariance divided by the product of the two volatilities. Then we have the sigma I, which is exactly the same like the one that we have here. And then we multiply the whole thing by 1 or by sigma m divided by sigma m. So that doesn't change anything in that product. So therefore, we simply have rephrased the same expression for the systematic risk component. And why did we rephrase this? Well, we can say that we have a sigma I here, we have a sigma I here. So in other words, we can eliminate that sigma I in the numerator and in the denominator. Then we have the sigma m times sigma m. In other words, we have a sigma m squared. And that, if we have that sigma m squared, what then remains is we have a sigma I m divided by sigma m squared times sigma m. And if I may draw your attention to that expression, this expression is something which we again know from regression analysis. Namely, this is the covariance divided by the variance. It's the covariance between the asset I and the market portfolio divided by the variance of the market portfolio, and that is the slope coefficient of a regression line when we regress the sigma I returns on the returns of the market portfolio. In other words, we have a linear expression where the I returns are the dependent variables and where the m returns are the independent variables. So that is the slope coefficient called beta of a regression analysis of I returns on m returns. And that's the reason why we replace the whole thing here by beta IM. So in other words, when we rephrase the systematic risk component on any asset I, then we obtain that this systematic risk component is the same like the market risk multiplied by the beta of our asset. So if the asset has a beta greater than 1, then the systematic risk is bigger than the systematic risk of the market. If the beta is less than 1, then we have a situation where the market risk exceeds the systematic risk of our asset. We might even have assets which have a beta of 0, so-called zero beta assets. Those assets do not have no risk, but they don't have any systematic risk. And the only thing which is important for pricing is systematic risk. So systematic risk is the only risk which is relevant for pricing, and systematic risk is beta risk. So beta times sigma m is the systematic risk that we need to look at if we look for the expected return on any asset in an equilibrium situation. And that leads me to the next step, namely here we have the step number 7, where we say that the mu I, which is the expected return on asset I, is equal to the risk-free asset times the expected excess return on the market. And here, in the capital market line expression, here on the other side of the table, we have a sigma, which is the sigma on the asset. But the only thing of the sigma which is relevant is the beta. So that is the only thing which is relevant. So therefore, what we are doing is we are replacing the sigma by that beta expression, which comes from here. So that is the beta of our portfolio. In other words, if I'm rephrasing the 7, then I find that mu I is equal to Rf plus mu m minus R times beta Im. So this equation here looks very, very similar to the equation of the capital market line. But the difference is that the capital market line here has a sigma component and here we have a beta component. So in equilibrium, beta risk is the only risk which matters, since beta risk is the only systematic risk. Sigma risk matters only insofar as it is driven by the beta. The proportion which is not driven by the beta is not relevant for pricing. Only systematic risk matters, unsystematic risk does not matter. The equation that we have here is the equation of the security market line. Again, a straight line. It's obviously a linear expression here. But the difference between the capital market line and the security market line is that the independent variable in the case of the security market line here is the beta, whereas the independent variable in the case of the capital market line is the sigma. So in equilibrium, the beta risk is important. The security market line is again a straight line which expresses risk and return relations in equilibrium. But risk is beta risk. And if I, as a last step, show you a chart where the beta risk is graphically represented, then we have a situation which looks like that. Then this is our situation here. We have the security market line here. We have the security market line here. And the very important point is that this is the beta risk here. Here again we have the analytical expression of the security market line. Mu, which is the expected return on any asset, is equal to the risk-free rate of return plus a risk premium, and that risk premium is equal to the expected excess return on the market times the beta of our asset with regard to changes in the market. So that is one of the most well-known equations in the financial education at business schools, but also in financial practice. Namely, it is the equation of the security market line, which we typically refer to as the capital asset pricing model. The capital asset pricing model has been derived out of Harry Markowitz's portfolio theory from the year 1952 over the capital market line paper of James Tobin in the year 1958, and it has then been developed by William Sharpe, John Lindner, and Jan Moussin in the years 1964, 1965, 1966. And all of those researchers have been rewarded by the Nobel Prize for developing portfolio theory of Markowitz, the capital market line of Tobin, and the CAPM of Sharpe, Lindner, and Moussin. That is a comparatively easy derivation of the CAPM, one of the most important milestones in financial market modeling.